What stock should I be buying? That's a question I get asked quite often, and I'm here to tell you that you're asking the wrong questions. The questions you should be asking are what key metrics of a stock I should look for, or what key fundamentals of a stock should I follow. The stock market is not as clear-cut and easy as people explain it to be, but I'm here to explain to you how to outperform the market and how to have the best success at beating the S&P 500 and the Nasdaq over the long term. The stock market has tens of thousands of companies in it, and it makes up the majority of the world economy. Some of these companies are extremely high quality and will outperform the market over the long term, but others are extremely poor quality companies and will most likely underperform. Your job as an investor is to screen out the good companies from the bad and invest only in the highest quality businesses that will lead you to significant outperformance over the long term. Now you're probably wondering, well, what makes up a high quality company? What differentiates a high quality business that will outperform from a low quality one? I'm here to give you a full example. Now, high quality companies are fundamentally the strongest businesses on the market. These are businesses that have a huge competitive advantage. The best way I could describe a competitive advantage of a business is a moat. So this is a term that was made popular by the famous investor Warren Buffett. In the Middle Ages, castles had a huge moat surrounding them. This protected the castle from intruders that want to take over the land and their goods. Think of the castle as a business, and the moat is what surrounds the business and protects it from competition. If we think of a practical example, think of Doritos. Many people go to the store and prefer to buy Dorito chips over the no-name brand. The no-name brand may cost significantly less, but people are willing to pay more money just to have the Doritos chips. The Doritos company has significant brand recognition, and this creates a moat around the business. Now you may take this example a bit further. Take a railroad, for example. In America, there's only a couple railroads under operation, and it's very unlikely a competitor is able to take market share from these railroads. If you want to build a railroad in America, it's going to cost you billions of dollars and be a very demanding task. You're going to have to get through laws and regulations, and you're also going to need to invest upfront a significant amount of capital and time. This protects the railroad companies from competitors, and it's why many railroad companies have been such good investments. They had a significant moat around their business. Looking at some of the railroad stocks in America, you could see that having a significant competitive advantage is a huge advantage when it comes to investing. But there's also some companies that have no competitors whatsoever. And these are companies that are called monopolies. Now, monopolies are even better than businesses with huge competitive advantage. They are businesses with such a big competitive advantage or such a big moat that they have no competition whatsoever. An example of a company that was a huge monopoly is ASML Holding, and they have significantly outperformed the S&P 500 and the Nasdaq by being one of the best companies in their sector. They had almost no competitors, and they were decades ahead of competition. Companies like this tend to trade at higher multiples, which basically means they're a lot more expensive than your average business. Now, I'm going to get a bit more into this towards the end of the video, but it's important to note that usually when you're paying for high quality businesses, you have to pay a significantly higher multiple than you would be for a lower end business. So what ends up happening is a lot of investors tend to concentrate into these high quality businesses, and that bids up the price significantly, which creates a very high multiple. Now, the markets aren't 100% accurate at all times. And to give you a good example of this, if we look back in 2022 when Facebook was trading at a $99 price tag, this was when the stock was significantly undervalued and the market was significantly mispricing the stock, and this gave a huge buying opportunity for retail investors like us. If you bought Facebook back during this time, you would actually be up over 700%, which is an insane amount of returns in such a short period of time. But this is what happens when the market misprices certain stocks. And when you see opportunity like this, it's very important you take advantage of it. So before we get a bit more sidetracked, I'm just going to continue to explain what to look for in quality businesses. So they need to be in sectors that are growing and very profitable. Now, there's some sectors that you should just not invest in. I'm going to tell you straight up that airlines and specific sectors are just very bad investments. Like, I would never invest in an airline company. That's because they just aren't profitable and they aren't good businesses to be invested in. The margins are pretty low. Fundamentally, they're not great businesses. They don't make that much money. So airlines you should just avoid. And that's not the only sector you should avoid. There's many sectors I just don't invest in, like banks, for example. I actually don't invest in banks because I find banks very hard to analyze and look into the fundamentals. I also find banks very hard to evaluate. So I don't invest in banks. I don't invest in airlines. I don't invest in retail. Asset managers, I also just don't touch. I don't really like these type of businesses, so I just don't invest in them. And that's the great thing about investing. You don't have to invest in something if you don't want to. You could always just pick and choose. You could even go years without investing in a single company, and you could still do very good in the market. All that to say, try to stick with sectors that are profitable and growing. You don't want to be in sectors that have just slowed down and are pretty much obsolete. If you invest in a company that made COVID vaccines, that's like probably the worst investment decision you could probably make. Just be logical and be smart with it. I feel like many investors online just neglect common logic, and I feel like logic could play a huge role in your investing style and your investing performance. Because if you're very logical, if you're a very logical person and you have an understanding that if you invest in a company and that company is in a sector that's growing, the company will most likely do well. So it's very important to have a good understanding of each fundamental in each business you're invested in. Next, we have to buy into companies with a strong management team. So it's very important a company that you buy into has management that understands the business and understands where to allocate capital. And this ties into my next point, which is strong capital allocation and discipline. You want companies that are not diluting the shareholder. You want companies that have a high return on invested capital. You want to be giving these companies $1 and they return $1.20. There's many companies out there that you give them $1 and they return you 98 cents or they return you 90 cents. And that's a value destroying company. That's an unprofitable business. You don't want to be investing in unprofitable businesses, but that's something many investors actually do. And it's something you should not be doing at all. So always find businesses that have good management and are very profitable. Now, everything I told you so far sounds great, but how do you actually tell if these businesses have a competitive advantage? Or how do you actually tell if these businesses have strong management? And this is where we get into fundamentals of a stock. So what you need to understand is stocks always follow fundamentals. It may take a couple years for a stock to catch up, but in the long run, stocks will always follow the intrinsic value of the business. So what this means is if a business is growing 20% year over year, the stock price will most likely follow and grow 20% year over year. If the business increases its profit margins year over year, then the stock price will follow and reflect that profitability. So stocks always follow fundamentals. So if this was 50 years ago, we would have to call up each company and ask them about their profit margins, about their metrics, about their fundamentals. But luckily, thanks to modern technology, you don't even need to know how to read cash flow statements or any financial documents to actually understand the fundamentals of a business. The application I'm going to be using to go into detail of these businesses is Stock Unlock. I'll leave a referral link in the description, but you could use almost any application for this made for stock research. So what I'm going to show you now is very important. I'm going to show you the difference between a good business and a very bad business. So first off, the example of a good business I have is Visa. We all probably know Visa. It's the payment processing platform. You probably own a Visa card. You probably own a Visa credit card. Almost everyone watching probably uses one of their products. And for the bad company, I'm going to be showing you AT&T, which is a telecom business in America. Now, right off the bat, you're going to notice a significant difference between Visa and AT&T. Looking at Visa's stock price over time, you'll see it compounded significantly over the past decades, and this stock has actually significantly outperformed the indexes. Visa is the example of a very high quality business. If you take a look at AT&T's stock price, you can see that ever since 2000, it has never recovered to its all-time highs. So why is it that one company significantly outperformed and one company significantly underperformed? This is where it all comes down to basic fundamentals. So let's dive into the fundamentals of Visa. If you look at the insights for this company, you're going to see that it has very good profitability and management scores. And this is no coincidence. This is because Visa is just a very profitable business and it has very good management. So you're going to look at some specific metrics that will help you understand Visa's business. If you look at the net margin of Visa, they have a 52% net margin. This means that the company is extremely profitable and does not have many expenses. This means that a lot of cash that Visa generates is passed on to the shareholder. What I also like to pay attention to is the return on invested capital and the return on capital employed. These are two metrics that basically show if Visa is reinvesting investors' capital at a high rate, and 44% and 40% is extremely high. This is something you want to see in a business like Visa. Something that's also very important to note is that Visa's revenue has been significantly increasing and has been increasing for over decades. You can see that the revenue has grown 10% over the last year. You want to be owning companies that have growth, because if a company stops growing, the profitability tends to go down because the company has to rely on current customers. So all around, you can see that Visa's profitability and metrics are very good. Now, going into a bad company, which is AT&T, you're going to see that the metrics look very different than Visa. Now, you're going to see that the net margin, instead of over 50%, it's going to be 9.55%. Now, that's not necessarily bad, but it's significantly lower than Visa's margin. What you're also going to look at is you're going to look at the return on invested capital, and return on capital employed is significantly lower. This means that the company is not able to reinvest capital at very high rates. I also want to point out that the growth is extremely bad. So the growth only increased 0.5% over the last year. But this is not the only thing that's bad about this company. If we go to the financials of this business, you can actually see that ever since around 2007, The revenue has remained the same since then. So AT&T basically went nowhere as a business over the last 20 years. This is not a company that seems like it has very good management and a huge moat and a huge competitive advantage. But what you may notice is many people might have invested in AT&T thinking it's a good business, when in reality, it's a very poor investment. If you look at this in contrast to Visa, you could see that Visa has just been continuously expanding their margins and expanding their profitability and growing their business. You can see that the graph looks completely different on Visa than it does with AT&T, and there's no coincidence for this. It's because Visa is just a superior company to AT&T, and investors will be more likely to outperform if they buy Visa than if they buy AT&T. These are not the only metrics to look at. If you also look at the diluted shares outstanding, which means if the company is diluting the shareholders or not, you'll see that Visa is buying back shares consecutively over the years, which means that you are actually holding a bigger portion of Visa even if you didn't buy more shares. And if we go back to AT&T here, you can actually see that the shares outstanding have significantly increased over time, which means that it's basically the opposite of Visa. So Visa increased the shareholders' value, while AT&T diluted the shareholders and made their position in the company worth less. Another metric I always like to look at is free cash flow. So if I see consecutive growth of free cash flow over time, it means the company is very profitable and generating a lot of free cash flow for the shareholders. And this cash could be used in case of emergencies. It could be used to reinvest at higher rates to generate capital. There's many things free cash flow could be used for. I see here that AT&T's free cash flow has been very unpredictable. Back in 2007, it had a high of $6 billion, and now it's all the way back to $4 billion after around 20 years. So it's very unpredictable free cash flow growth. In contrast, if we go back to Visa and we take a look at their free cash flow, you're going to see that Visa has just been consecutively increasing their free cash flow at very good rates. You can see that ever since around 2015, they have just increased their free cash flow. If we look at it on a year-over-year basis, you can see that Visa's free cash flow has been exploding. Because the business is so profitable, it generates a lot of free cash flow. Just taking 10 minutes to look at these businesses, you could clearly see that one is not a good investment and one might be a contender to be a strong investment and to own over the long term. That's just to show how easy it is to actually do research on the stock market. Now, obviously, these fundamentals are not the only things you should be looking at. There's many factors that decide if a stock is a buy or not. Some companies may have extremely strong fundamentals, but still significantly underperform the market. There's things that you just can't predict, and I'm going to give you a personal example of when I owned a stock called Evolution AB. So Evolution AB is a gambling company. They provide online casino services for businesses. And Evolution AB on paper is a fundamentally very strong company. It has extremely high profit margins. It has extremely good revenue growth. It was a very fundamentally strong company. I saw this company at a fair valuation and invested into it around last year. The problem with this company is even with good fundamentals, I still significantly underperformed on this position. There's many headwinds with this business that I did not consider, and after around a year, I acknowledged my mistake and sold out of the business. Now, this was a fundamental mistake on my part for misunderstanding the business itself, and luckily, my other positions significantly outperformed to make up for this loss. However, this just goes to show that even with a lot of research, you could still make mistakes. It's still very important to be slightly diversified to minimize losses. Now, lastly, we finally get to valuation. Valuation means the price you're paying for a company. It's very important you don't overpay for a company because even if the company is high quality, it could still lead to poor results. When you see businesses that have poor fundamentals and are overvalued depending on their ratios, you should tend to avoid these type of businesses. There's many different metrics you could use for valuation, but the most common used ones are a discounted cash flow analysis, a PE ratio, and a price to free cash flow. Different valuation methods are used for different sectors and different type of businesses. Some businesses could be based off their price to free cash flow, while others could be based off a PE ratio. I'm not going to go too in depth about evaluation because it could get very complicated and it could also get a bit controversial depending on which evaluation method people use. But I'm going to point out that a lot of basic evaluation methods are often pointed out with stocks. So you can see here, even looking at Google stock, you can see that it even tells you the PE ratio here. So that could give you a bit of a feel for how well valued Google is. If the PE ratio is above 25, usually it tends to be a bit higher. If it's below 20, usually it tends to be a bit lower. The average PE ratio for a company is usually around 25. Now, this is something to take with a grain of salt because valuation doesn't tell you everything, and one specific metric on one company would not tell you the full story of the company. But there's many videos out there explaining in depth what evaluation methods you should be using and how you should be using them, and I recommend you check them out. So to summarize what I've been saying this whole video, it all comes down to 3 basic metrics you should be looking for in stocks to outperform the market. If you listen to everything I said in this video, your stocks that you pick will most likely outperform the indexes. You have to find companies with a strong moat or competitive advantage. You have to find companies with very good management that are extremely profitable and growing their earnings exponentially. You also have to find companies with a margin of safety trading at a very fair valuation. If your company meets all 3 of these characteristics and it's in a strong sector with strong growth, then this company will tend to outperform in the long run. I hope this helped, and I hope you all have the best success with investing in the stock market.